In this morning's Money Watch, we have breaking news. Prices rose by 3% in June from a year earlier. It could be just what the Federal Reserve needs to see to cut interest rates. CBS News business analyst Jill Schlesinger is here to break it all down. Good morning, Jill. Hey, what's going on?
You're doing well.
All right, so let's just start off with the relationship between the inflation rate and the prices. Like, how are they related?
What we have to remember is that inflation measures the rate of prices going up,
right?
Okay? So it's the rate of increase. Normal economies, the inflation rate goes up by, like, say, 2% a year. And if you look at, like, the last 10 years before COVID, 2% a year. Then you get to COVID, it spikes. It was crazy. 2 years ago, 9.1%. Now we're in the 3% range. But the thing is, that inflation rate coming down doesn't mean prices are coming down.
There you go.
And I know it's confusing. If you look at the last 5 years, prices are up by about 23%. In a normal inflationary environment, it would have been like 11%. So if you still would have had higher prices, not this high.
I'm glad you made that distinction. Prices on consumer goods are still pretty high. So what tips do you have?
Well, look, I think that because prices remain high, you really have to focus on your big ticket items. You know what they are. That's housing, it's transportation, and it's food. And it means you really got to start tracking your money. There are so many great apps out there, and we're going to put a few of these up, but it doesn't matter how you track them, because it could be a spreadsheet, it could be hand, it could be through your bank. But unless you actually look at how you're spending your money, especially in those big categories, it's hard to make a dent.
You got to be disciplined. Interest rates have remained at these levels for a year now. When can consumers expect, some relief?
Well, the Fed chair testified before Congress this week, and he's saying, look, things are improving. We're not there yet. They have a meeting at the end of this month. However, we don't think they're going to do anything this month. I think they start to cut. Maybe they think about it. Not guaranteeing this. September. That's our next meeting.
Okay, so is there a risk for waiting too long?
Well, the risk is when you wait too long, you slow down the economy, right? And where do you see that? You would see that in the labor market. That would be terrible because we don't want to see job losses. We don't want to see wages stagnate. So we hope that the Fed can kind of navigate this little middle ground where we can get the economy slow, not too slow, bring the inflation rate down before it impacts the labor market.
Jill Schlesinger, I appreciate you. Thank you so much.
Sure.